We will give you a history of how we developed payments in Kenya. We believe we are just about to reach world standards. We have not reached there yet. We are just about, so we will tell you what we want to do to reach to that world standard. But before we tell you what we are doing, we will tell you where we came from. Payments development, automation of payments started in 1994 with SWIFT. Those of us who were in payments those days, before that we used to do telegraphic transfers, but now SWIFT came. Quickly followed by 1995, the first ATMs. That's when we started having automated cash dispensers. Then we automated the clearinghouse. We amended some laws to facilitate electronic payments. 2002 was a very busy year because we did direct debits. Switch came in. Then we tried to look at automating further the clearing and payments processes within the checks. Then 2005, we put the RTGS system that enabled us to then have faster payments on high-value transactions. It also allowed us to reduce dependency on checks because we said you could not issue a check of more than 1 million shillings in checks. It had to go through the RTGS. That pushed a lot of electronic payments, especially for the high-value, high-risk transactions. Then 2007, what everybody calls in Kenya the sixth world big six, M-Pesa came in, and it revolutionized small payments, quickly followed by other systems, high value, small transactions. Then in 2011, we further enhanced the clearing of the checks by putting check truncation in to digitize the check processing and reduce the cost as well as the associated risks with checks. After that, we looked at it and we looked at the payments industry in Kenya. Primarily before that, it was led by banks. But with M-Pesa becoming very big and very topical, and they were not regulated as banks, we started looking at what are the regulatory authorities around it. So the Central Bank of Kenya developed what we call the National Payment Systems Act, which said anybody in Kenya who's doing a payment system must be regulated by the National Payment Systems, which will be under the Central Bank. So now the Central Bank regulates payment systems both in the banking and non-banking arena. That is very important because then you have issues about regulation, uniform regulation across. Before, Safaricom used to say they are under Communications Authority, they are not banked. And then the Communication Authority would say we don't deal with financial systems. So there was a gap. But now with that, we managed to do that. We also developed what we called a policy in Kenya for payments. Essentially, looking at that, we said the regulator needs to concentrate on high value, high risk payments. That is 1 million shillings and above. That is the KEPS, or our version of RTGS, which we call KEPS, Kenya Electronic Payments and Settlement System. Then we created a National Payments Council to advise government on how to develop policy. Because all those developments I showed you earlier were not driven by any policy. It's just our own innovation and our own thinking that would say, I think we can try this, which is very good for innovation, but after some time, it becomes a lot of chaotic, especially when security and safety and consumer protection comes in. So the government needs to have a policy to drive a payments agenda for the country, or at least allowing innovations to work. So this National Payments Council is the body that would then be looking at developments in payments, advising government how to drive policy in terms of how do we see the future, and hopefully then enable an environment where regulation, interest, safety is all there. The third policy consideration is to ensure retail payments are not regulated heavily so that you can still innovate. Because if you imagine if you have to launch a product and you need central bank approval, which takes 6 months, by the time you get the approval, the product is dead. Because in innovation, 6 months is almost time to market. If you don't get it, you're done. So we need to leave the small retail players to innovate quickly, come up with something, and then when it gets big, that's when the central bank becomes interested, and then they can apply what we call, there's a term I'm trying to think, prudential regulation that is equivalent to the risk associated with the payment. So if I have a small payment system of $1 million, the regulation is not as high as the RTGS, which passes about $500 million. So again, you have to apply the same, an equivalent or equitable regulation. So essentially what we are looking at central bank doing is to do with risk management, settlement management, and national payment systemic risk management. Promote interoperability, because that is very important in terms of standards, in terms of cost, because you can imagine if everybody comes with a system that is not interoperable, then the cost associated between transactions between systems becomes very difficult. You're switching experts, I need not go into that very much. Then issues of competition, you don't want people to be unfairly taking advantage of their positions, so competition is very important. Innovation thrives where there is competition, so we must ensure we foster competition. Financial access, it's a constitutional requirement in Kenya. Everybody by the constitution is allowed to have financial access. We haven't reached there, but the constitution says that. So central bank ensures there is enough financial access, or they are driving financial access. And finally, consumer protection, because when you're making money, sometimes you lose focus of what the consumer's interests are. So somebody must be out there looking for the consumer's interest, and that's the central bank's policy consideration. After we did that, we then looked at how do we differentiate the transaction profiles in Kenya. So we have two large value payment systems, that is in 1 million and above, goes through the RTGS and the banking system. So all the banks, financial service providers who are regulated by the central bank, participate in that. Then in the retail payment systems, we have all these players, InterSwitch, KenSwitch on switches and ATMs, over-the-counter remittance, Western Union and all that, debit, credit, and then e-money schemes. This is where everybody is now focusing themselves to. But again, this changes, so we'll keep changing these as new things come through. Just to give you a financial background, if we look at mobile money, this is where everybody wants to learn about Kenya. In 2010, we had 39,000 agents. Last year, we had 165,000 agents. That's all mobile money, not just Safaricom. In customers, we had 16 million. Now we are at 34. I think it's grown because this is December last year. So it has grown a bit. Transactions, 11 million. Last year, we had 1.5 billion transactions on mobile. And then values, 732 million in 2010. Last year, we had 3.35 trillion. This is actually equivalent to, I think, half the GDP of Kenya is on the mobile transactions. So that gives you a perspective of how quickly those transactions move. ATMs, which is, I think, an interesting one because of cash. Cash is very king in Kenya. 90 to 95% of payments in Kenya are cash. 75% of the mobile transactions actually terminate in cash because it's just a cash movement. At the end of the transaction, the customer still cashes it. So again, that's part of this cash-heavy scenario. We are 2,205. There are 2,600, so not very big difference there. In fact, some banks are now cutting down on ATMs because they are looking at optional, different options. POS machines, 16,000, almost double growth within 6 years. Credit cards, this is not very good. Almost half, double growth again. Prepaid cards, this went up. Presumably, this one we think is because there was a failed attempt by the National Transport Authority to introduce what we call NFC, tap and go. And for quite a while, the big supermarkets gave out everybody, if you looked at them, they gave you a card, those NFC cards. And unfortunately, that didn't work. So I don't know what the transaction experience is, but there are quite a number of them out there. So there's a market to be tapped there. Debit cards have grown. This is primarily the debit cards for banked customers. They use them mostly at ATMs, but now we are moving them slowly out of cash into other pay points, especially point of sale and card paid transactions. Total card transactions in millions, 265. Last year we had 216, so it's almost flat. There was a time they went up, and then they went down. The reason they went down here was we introduced EMV standard here, and we actually retired quite a number of cards in the market because we were replacing them. So the transactions dipped in that year because we cancelled. If you didn't have an EMV card, we simply just cancelled it. So a lot of customers were forced to replace their cards at that point. But you can see the transactions picked up, and hopefully they'll keep going. Value of cards, 1.2 billion and 1.3, more or less flat. So this is what we are looking at to drive going forward. What we are looking for in Kenya is to develop what we are calling a cash-light society and a digital financial ecosystem. And that means end-to-end digital payment transactions. And for that, we must have digital payments, electronic, all of them fully, not M-Pesa where you go and cash it. We need to close the gap on M-Pesa, and they are doing that by doing this Lipa and M-Pesa and the pay bills, but we need to fasten it so that people don't cash to go pay cash. We want to reduce dependency on cash. It must always be available because it has to be up 24/65, 365. And then it has to drive financial inclusion. You can't have it just for the business guys like you and me. The very bottom of the pyramid must be able to have it. And then it must be cost effective. Because if it's too expensive, then of course you don't encourage usage. So we need to make sure the cost is lowered as much as possible. And then we have to have consumer protection. This is because right now, we need to ensure that there is a standard of regulation that is applicable, that is all the same through the NPS Act. Then interoperability, so that you don't have silos, so that the transactions can move seamlessly. Otherwise, people will be forced to cash. A very classic example is we have two payment systems on mobile, one called Airtel, which has about, 16% market share, and Safaricom, which has about 80% market share. The funny thing about it is if you're a customer of M-Pesa and you're sending money to Airtel, you will get the SMS in 2 seconds. You'll get that you've received cash. But if you want to access the cash, you as a customer of Airtel have to go to an agent of M-Pesa, identify yourself, you are given the cash, then you go look for an Airtel agent, load the cash, and then you transact mobile. That one is akin to, I send you an email, you print it out, go type it on your computer, then you read it. It doesn't make sense, does it? So we need to have interoperability to ensure that you can seamlessly move money, and then it becomes very, very easy to do. That is just one example. We have others within the banking industry. So for interoperability, we looked at how do we achieve that in Kenya under the law. So we have developed what we call a payment services management body. In South Africa, they call it PASA, I think. So that is the same principle. It looks at risk governances on a national scale, develops clearing houses for the different payment systems so that we can exchange instructions and settlement. Then look at a legal entity, so it will be run as a legal entity, separate, non-profit, and the idea is just to move standards in payments. Then we look at a switch, which will then be able to facilitate the exchange of settlement between the parties, because all players in the payments industry, at the end of the day, you need to get the money into the banking system. And then we manage settlement risk and liquidity risk under the central bank settlement system. Then between that, to facilitate interchange so that we can share costs and apportion costs accordingly, we have interchange principles. This is in a diagrammatical form, how it will seem. At the top, we have the NPS Act under the central bank, the Payment Systems Management Body, and then the different clearing houses. These are not exactly what they are. We are still working on them. But you will have, for example, for all ATM payment service providers, a clearing house for transactions to be exchanged between the players, a participant group, agreement or settlement, clearing rules, operator agreement for the settlement system, and then the cost sharing interchange so that we can share costs based on either usage or volumes or whatever it is. And then we put all those under each of those systems. So for this kit switch that we did, we have implemented it. It's been running for almost 6 months now. It became the first real-time interbank framework for Kenya. 24/7, it works 24/7, 365, 99.999 uptime. It's a product. We are not selling any product on it. The banks will develop whatever products they want and put it in there. So we are basically providing the pipelines where banks will then run the product. We will then interface the banks to payment service providers, other switch providers, and such. The idea is to lower costs by sharing infrastructure. You can imagine if everybody is putting their own fiber optics all over the place, it will be crazy. So we are sharing the infrastructure, lowering the cost. Then we put technology standards by developing national standards for payments. And then we have a secure platform where transactions can then be pushed through. Value for customers, it will be 24 hours. So for sure, we will have a 24-hour economy. Kenya is very good on business, but unfortunately on Friday, it closes until Monday. So if you are coming in, Russians, you're coming in, you're carrying a TV, you want to bring a TV for somebody, you can't pay duty on it until Monday. So you have to leave it at the airport, go to the hotel, and come back for it Monday. It doesn't work like that for a 24-hour economy. So this system allows you to pay up to 1 million shillings real time. And the money will move into the banking system and you get your payment and you don't have to worry about it. So we can actually have an economy running 24 hours. Settlement will happen between us, and then the central bank will underwrite the settlement in the clearinghouse. So in the event of a bank failure, settlement will be guaranteed. So we have no issues about systemic issues there. We will then manage risk by having a settlement system. Currently, some switches that are in operation have their own silo settlements. That is very expensive for players and risky for players. So once we centralize that in the central bank, then visibility by the central bank is seen. Then, of course, cash, we want to reduce as much cash as possible. In a cash-light environment, we want about 50% in 5 years. We should have 50% of all transactions going through digital. That will actually make us cash-light. And then we are looking at end-to-end digital channels. And then, of course, because they are all electronic, we can have audit trails. We can see transactions up to the second. The central bank can monitor movements and statistics and be able to then do what we are calling risk profiling. The next one is financial inclusion. With that, banks don't need to open branches. They can actually give digital alternative channels to the customers, and customers can transact digitally without having to come in. And we can develop additional products on it. So how does this switch work? The first step, which is currently on the mobile, is I can want to pay Mr. Pavel. I go to my channel, whichever it is, mobile, ATM. Instead of withdrawing cash, I give an instruction to my bank, send money through the switch to the other receiver bank. They receive the credit, it's given, I get a confirmation credit is done, and then I get an SMS, the transaction is complete, you get an SMS, you have received money. If the transaction doesn't go through, you don't know, but I'll get a message that it has failed and why it has failed. So within 45 seconds, you should be able to. That was the original intention. It actually works in 22 seconds. So we can guarantee this across. So far, we have 30 banks on the switch with plans to finish the other banks by December, 45 banks. So if this happens, we should be able to facilitate payments across the industry in 45 seconds, real time, up to 1 million shillings. In the future, we want to develop that into a superhighway. Government is looking for payments. Right now, government pays electronically. So if you are contracting government, you will be paid directly to bank. But if you are paying government, right now they have cash. So they are moving to a digital platform and they want to eliminate paying government by cash. So they are looking at putting point of sales, mobile payments, or whatever it is. We want to put that infrastructure in there, connect the central bank in there, so that if I'm paying any government ministry, department, or agency, or the KRA, they can then get their money in 45 seconds, their money into the central bank account, credit given, everything done. That will ensure government doesn't lose revenue and they can get their money much, much faster. The utilities, we want to link them through banks. Then you can pay for your electricity bill wherever you are, and it will be very efficient. On the top there, we are going to have banks. The vision is, oops, sorry. Sorry. Oops. Okay, sorry. I need help. Okay, yes. On the top here, what we are looking to do is, because the banks are connected, then the banks will facilitate transactions to the payment service providers. So if you are a payment service provider, you don't need to be linked here. You get your bank to sponsor your transactions to come here, and they can move to any commercial bank or any of these players, and then settlement will be done by your bank at the central bank. That way then you don't have to you eliminate, for example, if I'm a utility company, Kenya Power, I don't need to be connected to 45 banks. I can choose one bank, and any customer of the 45 banks can pay into this one bank through that one connection. The same thing with the other people. So for those players, they don't have to have multiple integrations. Get one bank, get an API, you are good. You can get payments from 40 million Kenyans. The same thing with integrations. In a bank, I don't have to worry about all those integrations. I simply integrate to one infrastructure. Government integrates to one infrastructure. Everybody is up. The playing field is level. You now compete on service, uptime, and cost. That is the way we are looking at this. And then it will enable a system, which we are calling the digital financial ecosystem, of a market niche that we are calling digital payment service providers. So anybody who has an accounting system nowadays that cuts checks and all that, you can actually now develop applications that will enable you to do payments digitally and just move the money between these banks, and people get paid without actually handling cash. And that generates a new market. We can develop a platform with a lot of innovations that we just overlay whatever technology we want. And we will lower the barrier to entry for players. If you ever set up a company, you know how difficult it is. But if we have this infrastructure, then it becomes very easy for somebody to just layer and come in and partner with providers like yourselves. So that is what we are looking to do, and that is our vision for a digital financial ecosystem.